Hi everyone, it's PJ Patterson here on Thursday, May 7th for a market update. We've got lots of stuff going on. It seems like in the last week or 2 weeks we've had quite a bit of motion in the stock markets and also quite a bit of, I suppose, enthusiasm for the stock market, but a lot of the underlying stuff hasn't really changed. And I'm going to get into that today. So top three things, we're going to lead off with earnings. Have a discussion about where we're up to in the earnings report. So we've got most of the S&P now reporting. The second thing I want to talk about is the credit cycle. So if you're following any of the mainstream media, then you would have seen a number of articles this week talking about what banks are doing, cutting dividends, etc. So we're going to go into that. And then finally, just going to, I guess, talk a little bit about FOMO, which stands, if you don't know what FOMO is, it's fear of missing out, and where we still are in terms of quad four and what we're actually continuing to look, or I'm continuing to look at, that's going to suggest that we can begin to pivot out of quad four positions, maybe into quad three or whatever. So let's just get into earnings. Let me just pull up a chart here of earnings. Hopefully you can see that well. So the first thing is, and once again, compliments to my service provider Hedgeye for providing these slides, but looking at the S&P 500 sales and earnings growth, a little over half, actually more than probably, what's that, three-quarters maybe, two-thirds, I don't know, for all you maths guys and gals, have reported, and earnings growth is horrendous, almost 10% down earnings growth, or if you wanted to round up and say 9%, that's fine too. But the sectors hardest hit, obviously, are the things that have been most affected, right? So if you look at financials, they're showing what's that, minus almost 37% with most of the financials reporting. Energy down, interestingly, only a minus 1.15%. Materials, industrials, consumer discretionary, all the things that you would expect to be impacted by a global economic shutdown are getting slammed. And the thing, and I probably mentioned this before, but the thing to, I think, recognize with this is that this earnings cycle does not include most of April. So it doesn't actually really include the deep, cuts and deep employment losses that we've had in the last month because of COVID. So what that really tells you is that the earnings of corporations are going to continue to deteriorate for a period of time. And the other thing to probably say about earnings, and I think I mentioned this before, is that we're not just going to return to normal, which whatever that is going to look like in, say, the next couple of months, even once governments release the pressure of, staying at home and sheltering in place and all of that. Once they allow the economy to sort of reopen, it's going to be a completely different look and feel of the economy, and it's going to take a while for the economy to restart. So earnings aren't going to just shoot back up to pre-COVID levels, and of course we're going to have to go through a credit cycle, which is my second point. The credit cycle, for those of you who don't, I guess, really understand business cycles, I think most of you probably do because I talk about it enough. But we go through a period of contraction, which we're in right now, which will lead to a period of expansion. And typically the contractions are shorter than the expansions, but the contractions also cause a lot of damage, right? So you have a lot of bankruptcies, you have a lot of businesses failing, you have a lot of people going to the wall, that sort of stuff. And the expansions last a lot longer. So one of the key things that I wanted to highlight in all of this is if you've been reading or watching any of the mainstream media stuff this week, Westpac has come out with some deep cuts to earnings. They've provisioned for, they're putting hundreds of millions of dollars aside for loan loss provisions. NAB did that last week. I suspect we're going to continue to see these sorts of announcements coming from all the major Australian banks. As you all know, I'm a finance broker, and my experience has been so far that banks are tightening credit big time, and credit is very restrictive. Not only that, but they are crawling all over every single transaction. And of course, we don't have the unemployment figures yet in Australia, but we're going to have a lot of people out of work. I know from my own client base that we have a number of clients who have been put on reduced wage. So they've taken a 10, 15, 20% wage reduction. been asked to take annual leave, that sort of stuff, and use those things up. And of course, just other things like reduced working hours, and all of those issues are going to, or have yet to fully play out in the economy. So what that's going to effectively do is it's going to be a self-reinforcing cycle of the banks saying, we need a provision for losses, we have to tighten up credit. That creates a situation where, because of that, credit isn't flowing in the economy continues to get worse, defaults continue to rise, people continue to become unemployed. Banks then, get that negative feedback loop and go, oh, see, it's getting worse, right? So this is the bizarre nature of, I suppose, a credit cycle, and it's a real shame, because if you really think about how a credit cycle ought to work, banks and all of these credit providers shouldn't go when times get better. And it's probably going to take another 3 to 4 years before they forget about this period of time, and then they start to really open up the credit spigot again. But it's one of those things where they should what's the word I'm looking for? They should employ more prudence during the boom times, so that when the bust comes, they don't have to tighten up as much, if that makes sense. But unfortunately, these businesses don't think that way. And the reason for that is, of course, CEOs are driven by earnings, creating shareholder value and all of this bullshit. And so they take more risk during the boom times. They put on, they write more loans, all of that stuff. So anyway, the point I'm trying to make is that we are still in the early innings of this credit cycle. And the important thing that you need to know about the credit cycle is that as credit contracts, so debt, I'm really saying debt, like those two words are interchangeable. Credit and debt, same thing, right? Because if you take credit from the bank, you have effectively borrowed money, right? A credit card, if you use it, you've just gone into debt. You take a loan out, it's debt. They refer to that as credit growth, but it's actually debt growth. So we live in a debt-based monetary system, and in order for economies to grow and prosperity to increase, unfortunately, the system we live in is that credit or debt needs to continue to grow. Now, there's a mantra out there that you can't solve a credit crisis by creating more credit. And this is something that the U.S. hasn't learned yet. I'm sure you know that the Federal Reserve, I've talked about it, but I'll just refresh your memory. The Federal Reserve and the Treasury in the U.S. are printing and borrowing literally trillions of dollars. I think in this quarter, maybe it's actually, this month alone, I believe the Treasury put on something like an additional $3 trillion of debt. I mean, it's just, the numbers are mind-bogglingly huge. And the problem they've got is that they're not going to get the incremental gains in gross domestic product and just economic prosperity that you would have gotten, say, from going from a much lower base. So that was a little bit confusing. Sorry. What I'm trying to say there is that as the pile of debt gets bigger and bigger and bigger, and more people and more corporations get more and more indebted, borrowing more money doesn't solve the problem. It's like, someone who's addicted to drugs, they want the next hit, but giving them a bunch of drug isn't going to actually cure them of being a drug addict, if that makes sense. So they just have to go, they have to get off the drugs, go cold turkey, and try to clean themselves up. But that's never going to happen with our current economic system. So point number 3 is, just before I lock that off. So we're in the very early part of the cycle. And I know, because I've had conversations with a number of you about bank lending and so forth. I think the best thing you can probably do right now is avail yourself of the very low interest rate environment that we're in. And the final thing I'll say about this is the Australian Reserve Bank did announce this week, of course, they're not, raising rates, they're not going to cut rates any further, but they pretty much said that we're going to have low rates for a long time. That was the intimation anyway. So it's likely we're going to be in a very low rate environment for a number of years, quite possibly. Now, that doesn't mean that interest rates can't go up, and they will go up. So if you do recall any of the other conversations I've had with you about interest rates, you know that the market actually sets those. So as credit tightens, what will eventually happen is that credit will become more expensive. So just bear that in mind as you I suppose, as you think about your home lending and that sort of thing. So now's not a time, I think anyway, to lever up and to go and make any big purchases in housing or anything like that. Unless you're buying a principal place of residence, of course, this is a great time to do that because I think you'll get some discounts. But now's probably a time for you to consider locking in maybe a 2-3 year fixed rate. Money right now. The amazing thing about this, ladies and gentlemen, is that we have the cheapest interest rates ever in Australia. And people are moaning about I'm paying 3.1%, let's say, and I should be paying 2.9%. I'm just going, guys, seriously, 2 years ago you were paying 4.5, 5. So anyway, just bear that in mind, keep it in perspective, because at some point we're going to go back to a much higher interest rate environment, and you'll be reminiscing about the days when we had the ability to get a 3 year fixed rate for 2.45% or something like that. Anyway, moving on to my final point, that's FOMO, fear of missing out, and quad 4. Just wanted to remind everyone where we still are in all of this. Global economies are still absolutely stuffed. And just before I move off this page, one of the things we've got coming out on Thursday and Friday are the initial jobless claims and the unemployment number in the U.S. So unemployment number is tipped to be 10% plus in the U.S., and the initial jobless claims is expected to rise again by a couple of million. Now, the last few times they've had these predictions out for the jobless claims, they've been off by a factor of multiples, and so we're up to, I believe now, about 33 million jobs lost and people on unemployment benefits. That is unprecedented, and it has wiped out basically all of the job growth that began from sort of the Obama administration right through Trump's administration. So all of that's gone, and it's continuing to get worse. So we have some key numbers coming up, and what's been happening of late in the market is, people are still, I don't know, they're trying to price in this V-shaped recovery and all this crap. You hear this constantly bantered around on CNBC and these idiot box TV stations. I only kind of tune in and look at some of this stuff just to see, what they're doing, and I usually do the opposite. But I want to just remind everyone that first and foremost, the volatility index, which again is one of the key measures that we look at to know whether or not we can invest in, broadly speaking, of course, whether we can invest in stocks. And we're still at a volatility number of plus 31. Now, that's not a hard number, obviously, but because really the range is kind of like sort of 27 plus now. But we're in the 30s. And so for all intents and purposes, the stock market is not investable. Now, there'll be pockets of that. And if you're getting trade reports and things like that from Interactive Brokers, you know that I bought some healthcare and I bought some consumer staples. So I'm starting to look to build some positions in some of these things, because those positions will do really well as we move back into, say, quad 3. And they can be quad 4 positions if volatility doesn't spike again. So anyway, I'll just see how those go. But nevertheless, it still means that we need to be cash, treasuries, gold. Those are some of the key positions that we'll hold. So even though we've seen the Australian market rally, I think it's up probably about 25% off its low, but it's still down 15% or so from the peak. U.S. would be very similar. What happens is people think they've missed out on something, and they're thinking, oh, I missed the bottom, so I need to now start buying into these rallies. But they do that using their gut feel, right? Or they're looking around, or people are saying to them, oh, we've missed the bottom again, blah, blah, blah. But what I'm telling you is the data does not suggest that at all. And I just want to share with you, before I sort of wrap up, share with you a couple of data charts that show you. So these are things that happen on a daily basis that come out and are reported. So I guess the main thing I want you to pay attention to is what's the color of most of the data points on these tables. And this is stuff from all over the world, mind you, various countries in the world. All of it is red. Now, red is bad. It means that there is a serious problem. I'm just going to get the one most recently here. It means that there's some serious shit going on in economies. And so some of the key numbers are the purchase managers indexes and the and the composites, as well as a breakdown of those, and they're all negative and they're all dropping, and the rate of change of those things is accelerating to the downside. And so once again, I just want to reiterate, and I haven't really had any of this feedback from my client base, which is fantastic because it means you're listening to these updates, you're absorbing the information I'm telling you, and of course the market is probably, for all intents and purposes, confirming what I'm telling you. So you aren't panicking, like a retail stock investor probably would about missing out on something or whatever. But again, my point on this is to say that we are in a bear market bounce, and if I didn't think that, or the data and the people that help advise me didn't think that that's where we were, then I would tell you that and we would position accordingly. But the reality is that this is the eye of the storm. So when you're in a hurricane, not that I've ever been in one, but certainly, and I don't ever want to be, but if you ever have been involved in a hurricane or you've studied any weather patterns, you know that there's an eye of a hurricane. And when the eye passes over you, it's calm. It's almost like there's no problem with the weather. But the reality is that around you is swirling this hurricane. So we, I think, are somewhere in that eye of the storm right now. And as more data gets reported, especially once we get the April data, and again, we'll see May data too in June, obviously. I think traders and people are going to all of a sudden go, holy shit, like this isn't going to recover overnight. And then there's this expectation that's being built, I think, in the market too, that it's like it was in 2008. But that was a completely different crisis for a lot of reasons. So just to wrap up today, nothing really has changed in terms of my narrative. I think you probably sense that. But I just want to remind everyone that, there's still going to be a lot of time and space between now and a quote unquote recovery, when we can really start to pile into growth stocks and things that sectors and asset classes that are set up for a growth environment. We are nowhere near that at the moment. So again, not that any of you are panicking about that and ringing me saying I want to be exposed to stocks, but you're obviously going to see, if you're looking at your account, you're going to see treasury positions. They're going to go up and down. The Aussie dollar is going to go up and down. But the trend is still bear market. All right. So just a reminder that within the trend, you're going to see short-term moves that are going to go counter trend. But when the trend changes, believe you me, I'm going to tell you, and we're going to position accordingly. So as always, if you have any questions or you want to contact me about something, best thing to do is hit me up in the comments in Facebook. That's been really great, by the way, the engagement there. So please do continue to do that. Ask questions. I love it because it's a great opportunity for me to teach and pass on knowledge and information. And many of you may, have had that particular question that one of the clients might have asked. So please, I love those questions. Keep them coming. And with that, I will say, stay safe. Hopefully everyone is still doing well. Reach out, check on your neighbors, check on friends and family. Obviously, make sure everybody's doing okay. And please do shoot me any questions you might have. Have a great weekend, and I will be back with more updates as and when they are necessary. So aside from, doing a weekly thing. Anyway, guys, take care. Talk soon.